Bună ziua din nou, l-avem alături de noi acum pe Liam Bailey, Global Head of Research pentru Knight Frank, compania de consultanță imobiliară. Suntem în direct cu el din Londra. Hello Liam, thank you for joining us today. And we are going to talk about the wealth report.
Brilliant, thank you very much for the invitation.
Liam, what happened with the ultra wealthy people in 2022? I saw that you mentioned a decrease in the numbers of the wealthy of the world.
Yeah, so we've recorded strong growth in wealth creation over the past decade, and that's been the key finding each year in the wealth report as we've delivered the reports each March. And then for the first time, really since the financial crisis, we saw wealth creation go into reverse in the past 12 months. And so the data was for 2022. And really it was a reaction to that historic shift in interest rates that we saw in most developed economies, where interest rates, rose from very low levels, which they'd been at really since the financial crisis, to be fair, more normal levels. But that created a shock in financial markets, and it impacted in terms of the value of financial assets. And that led overall to a decline in wealth portfolios, and actually fed through to a decline in the numbers of very wealthy people around the world. So in short, our findings suggest that actually the total value of wealthy people's portfolios, including all assets, declined by about 10% over the past 12 months. And the numbers of very wealthy people globally, and we count ultra high net worth individuals as being people with more than $30 million or more, that number declined by about 3.8% in the last 12 months. Europe was probably worst affected in other parts of the world. Places like the Middle East did very well, but it was it was the first slowdown we'd seen. I think just putting it in context, though, the one thing we know over time is that the global economy is very good in the long run at actually generating wealth and creating wealth. And our forecast for the next 5 years is to see positive growth in terms of wealth creation at a global level. And that will, begin to see a sort of reversal of the recent trend that we've seen facing global markets.
Mm-hmm. Why was Europe more affected than other regions? Because when I look at your map, Europe is down by 8.5%, but the Middle East is up by almost 17%. Africa was on a growth, 6.3. What happened in Europe? Did it have anything to do with the real estate market?
Yeah, well, actually the real estate market performed relatively well last year. So it wasn't actually, house prices in most markets have fallen over the past, say, 6 months. But in terms of our data, which was for 2022, most markets actually saw prices still grow last year. Most of it was front-end loaded. It was the first half of the year rather than the second half of the year. The biggest impact, really, to be fair, was financial assets within the portfolio. That's where stocks and shares, bonds, etc. That's where the negative hit came for portfolios. And because Europe, to an extent, was in the the epicenter of the storm, inflation picked up faster here in Europe than other parts of the world, and interest rates rose, have risen rapidly. That's really been the driver for that weak performance of financial assets. And also, to be fair, Europe saw a weakness in terms of consumer confidence and business confidence, partly to do with what was happening in Ukraine, obviously the crisis there. So all of those things really pulled together, conspired to make it a difficult year for European markets and therefore for wealth creation.
Mm-hmm. Are people going back to the office? Are people in Europe interested in investing in real estate now in 2023?
Yeah, so we saw real estate most wealthy people are very comfortable and confident, investing in properties to live in, second homes, etc. They understand how those markets work, and they are very happily buying and selling residential properties for their own use. When it comes to kind of commercial investment property, it's a slightly more, it requires a little bit more knowledge of the sector. It's not as liquid as other markets like, financial assets. It's a slightly longer term investment. So it isn't for everybody, but we have noted over the last 10 years that actually there is a shift in the ultra high net worth portfolio towards direct ownership of property. So we're seeing many more people looking at that sector. And I think the attraction for investors is unlike, say, a financial asset, you buy a share, it's exactly the same as other shares in the same company. With real estate, every property is different. Every property is impacted by, a different kind of local micro market. You can enhance a property by renovation. You can extend properties. You can get planning gain. So I think there's a feeling that actually you've got more control over the asset. Of course, what's happening to the broader market happens in the background and will impact on your investment performance. But I think there is a degree of attraction from the tangible nature of property assets. Mm-hmm. You mentioned offices at the beginning of your question. And of course, the office market's been heavily disrupted by the pandemic and people working at home. We're definitely seeing now, kind of 3 years on, a concerted shift to people being back in the office. I think there's a recognition that we probably won't go back to where we were pre-pandemic, and there'll always be an element of more of people working at home or working remotely. But I think the recognition actually for businesses that in terms of things like networking, training, upskilling workers, actually collaborating on projects, actually being together in person is still a really valuable thing to do. The opportunity, I think, for investors is huge, though, because most offices are built to house people who are kind of processing email all day. So sitting in cubicles, just doing, typing away on computers. I think there's a recognition that actually that work can be done from anywhere. What's the point commuting an hour each way from home if you are just processing email in the office? So I think the opportunity for investors and developers is actually to future-proof offices, actually make offices a much more attractive environment, a better environment for collaboration and training and so on. And actually offices becoming a much bigger part of the sell and the brand of a business, actually to attract talent to your company to come and work for you. If you've got a great office with a really attractive environment, it really helps. It's a big sell for companies. And bear in mind, for most companies, 70% of your costs are in your staff costs, your salaries and bonuses. And your real estate is probably sort of 8-10%. So actually investing in that 8-10% can actually pay dividends in terms of your ability to attract the best quality staff in the marketplace.
And are people now more interested in buying or renting apartments downtown in the center of London, for example, or around the city, or in other major cities in Europe?
Yeah, so I mean, the pandemic was really interesting. So the first thing that happened was the big cities like London and outside of Europe, go to New York or Miami. People kind of moved out of cities. They were looking for, or wealthy people moved out of cities. They were looking for space, privacy, security, I suppose. Open space, outdoor space, and so on. So you saw a big boom in kind of suburban markets and places in the UK, in the country, around London, and the same thing happened in Paris and other big cities in Europe, because cities were closed down. They were locked down during the pandemic, and actually cities are all about meeting people, going out, restaurants and bars and so forth. And actually that is the whole point of the city, actually, is to kind of meet people and to kind of congregate. And actually when that process was closed down, cities became quite unattractive places because they're crowded, but actually you can't meet people. What's the point? But I think as cities reopened in 2021, we saw a rapid increase in demand for people to come back into cities. There was a recognition that actually you would be back in the office. You would need to be seeing people. You want to see people. You want to meet with your friends and family. So city markets did very well. In the last 18 months, really seen a big revival in demand in cities. There's definitely been an impact in terms of the cost of debt. The background is, of course, has been interest rates have been rising. That's slowed some demand to an extent. But here's a thing to look at. If you look at so Knight Frank, we have a tracker of global rental data. We just produced our latest results this week. And actually 8 out of the 10 markets that we track in terms of sort of London, New York, Miami, Paris, Geneva, etc., 8 out of the 10 leading global markets are seeing record rents right now, and rents have risen in places like Singapore by 60% over the past 18 months. Testament to the fact that actually there is this big revival in demand for cities and for city living, and it's pushing rents to kind of record levels. That's causing issues for tenants and renters in terms of cost of living, of course, but actually just going back to the issue around investment opportunities, actually one of the biggest areas of growth we're seeing in terms of where investment is moving in the real estate sector is into the living sectors. So people building blocks of apartments for rental. That block is owned by a single landlord. That is a huge growth area for us at the moment. And actually, that is hopefully where governments are looking to see how they can kind of square the circle in terms of this demand for accommodation, this rapid rise in rents, the impact that's having on tenants, but actually supplying more purpose-built accommodation in city centres seems to be the way forward in helping to address that issue.
Mm-hmm. What will happen in the next 5 years with the ultra high and high net wealth individuals?
Yeah, so I think I kind of mentioned, at the beginning, I think it's clear that there was a hiccup in terms of wealth creation over the past 12 months. I think that the global economy has taken a shock from what's happened to interest rates, of course. There's probably more of that to come over the next, say, 6 months. But we know that actually the global economy is very likely to see renewed growth from, say, 2024 and beyond. Many parts of the world are not suffering the kind of slowdown that, say, the Eurozone or the UK is seeing at the moment. And we know the global economy is incredibly good at delivering growth and wealth creation long term. So our forecast is for probably 28% growth in ultra high net worth populations globally over the next 5 years. And I think the question there is actually for developers, for investors, and to be fair, for governments as well, is where does that wealth move? And the one thing we know from findings in the Knight Frank Wealth Report is wealth is increasingly mobile. There is a desire for wealthy people to kind of to be based in different locations, to be able to travel and work in different locations. And some governments are really focused on this and their ability to attract mobile wealth. So look at what's happening in, say, Singapore and Dubai with visa changes to attract, longer term working residents. Hong Kong's doing the same thing. Switzerland, Italy, other parts of Europe are seeing attempts by governments to attract footloose workers, entrepreneurs, skilled workers, etc. And I think that competition for talent and for wealth by governments is only going to increase over the next, decade as governments compete for tax revenue. Lots of governments in the Western world are indebted at the moment. They're looking to raise revenues and taxation. And it's very hard to do that unless you can attract talent and, entrepreneurial individuals into your economy. So I think there will be much more of that. And I think economies or countries that can't articulate a narrative to attract talent, I think will struggle economically over the next decade. So I think that's where there's going to be a very interesting shift, I think, in policy from governments to try and see how do they sit within that framework of trying to attract very mobile workers and very highly skilled workers in the future.
Is this how the Emirates increased in the last year, in 2021, 2022, because they attracted investors, they attracted wealth?
Yeah, I think that Dubai has had a very strong run. I mean, Dubai has been an incredible success story for the last 2 decades, but it has been a volatile market. It's had quite a volatile economy and a volatile housing market until recently. I think what happened through the pandemic was Dubai probably slightly sort of came of age, I suppose. It had a very good rollout of vaccines, so it was reopened earlier than a lot of other economies. It also very intelligently shifted the visa rules to encourage longer term residents to move to into Dubai. That had an obvious impact in terms of demand for accommodation and impact on pricing, but it's also had a deeper impact, I think, in terms of the economy. So Dubai has proved the case for a global hub within the Middle East, and actually Dubai works very well at attracting workers out of Europe, the Middle East, the broader Middle East, India, and actually parts of Asia. So it's playing quite a pivotal role now, I think, in the global economy. Interestingly, I think what will be interesting to see how it develops is Saudi Arabia has got similar ambitions. I mean, you know, I think there is a recognition there's 10, 20 years maximum of you know, money coming out of oil and gas. And actually, at a certain point in the future, you know, there will be big improvements made in how renewables are kind of created and costed. And I think over that period, Saudi Arabia is kind of trying to future-proof its economy and probably will look to do a similar thing as Dubai has done to create locations and environments where global workers want to be based. So I think there will be more regional competition for Dubai in the future. But to be fair, it's a reflection of the success of Dubai that other locations want to emulate what the city has done.
But on the other hand, I see that for the next 5 years, Knight Frank estimates that Hungary, Turkey, and Poland will increase its ultra high net worth income individuals.
Yeah, those economies are, you know, really interesting environments. You know, on you know, compared to, you know, the developed world average, they are, you know, younger populations. They are growing, you know, relatively rapidly in terms of economic growth. They're coming from a lower base, so actually the potential there for growth in economies is really big. I mean, there are some forecasts at the moment that actually Poland, for example, will outpace the UK in terms of average incomes in the next decade and a half. So these are really interesting environments, and I think there will be a lot of you know, positive kind of news in terms of business openings and you know, inward investment into these markets. And I think Turkey's gone through some, you know, significant problems recently around inflation, and it looks as if actually the new administration under Erdogan is probably looking to change tack and actually probably follow a slightly more kind of establishment approach to taming inflation, which is on balance probably good news. And actually, I think if inflation can be removed from the Turkish economy over the next, say, 5 years, I think the outlook is much more positive. So I think, look, I think all of those economies you just mentioned have got real upside potential, and I think will be really interesting to watch for the future.
I've read a very interesting book, The Next 100 Years. It was written about 10 years ago. And in that book, the author mentions that Turkey and Poland will be regional superpowers.
Yes, well,
does this anything have to do with this? Because they now become local big economies in this part of Europe. Poland a bit in the north, Turkey in the south, and they have a very important point of view.
Yeah, I mean, look, I'm not a geopolitical specialist, but I think it's quite clear that, I mean, Turkey already plays a very interesting kind of geopolitical role, you know, with obviously a very deep relationship with NATO, but also, you know, close relationships with other economies in the region and outside of the EU. So I think the potential for Turkey in terms of future growth is massive, and that will come with, you know, obviously an increasing share of voice when it comes to you know, regional and geopolitical issues. I think Poland has shown itself through the Ukraine you know, crisis to actually, you know, punch above its weight economically in terms of you know, diplomatic kind of power within the EU. So actually, I think the center of, you know, the center of gravity within the EU has always been kind of centered around, you know, well, it was the UK, but also France and Germany. But I suspect actually Poland will begin to kind of wield greater influence over time, and particularly with its neighboring countries as a bloc. I think they could be quite an interesting kind of counterpoint to the kind of the German and French axis.
But on the other hand, we see here Hungary, and Hungary is not a very big country, but its investment funds seem to be more and more active, also in Romania, buying property. And Hungary is attracting more and more investments. They have Mercedes, BMW, new battery plants being announced. Will this influence? And this is why we see also Hungary in this top.
Yeah. So everything is. I mean, ultimately, in terms of wealth creation, you basically follow the economy. So, whichever economies are growing stronger or doing better, you will see strong increases in kind of wealth creation. So, those figures for Hungary don't surprise me at all. And I think let's be honest about this. Eastern Europe economies have done well over the past decade. They joined the European Union with much lower labor costs, but actually very highly skilled workforce and educated workforce. It was a logical step to take for manufacturing businesses, but increasingly service businesses to relocate into those economies. It makes perfect sense, and actually kind of kickstarts the local economy and actually begins to kind of build on those successes. But there's further to go on those trends. I also think probably you could argue that some of the reshoring or nearshoring that's happening within the global economy, slight kind of move out of China in terms of some economic activity. Where does that go? You're seeing it in North America with some of that investment going either back into America or into Mexico, and actually in the European Union's or in the European context, the logical place for some of that activity is into locations like Poland, Hungary, and Romania, because it logically, I can do this at a lower cost base. This is a good story for the local economies, and I think with more of that reshoring process likely to happen over the next decade, then actually that's a net benefit to those economies.
And how do you see Romania? What's the potential here?
Oh, I think it's huge. I think what is interesting actually, there was I think when you look at manufacturing industry opportunities, I think that there's massive potential. You've also got again, compared to the European average, you've got a lower cost workforce, which is attractive to businesses looking to expand and grow their operations. So that's a plus point. I think the other issue is around there's a huge increase in interest in investment in the natural environment, natural capital, investment in forestry and natural resources. And I think that Romania's got a very strong story to kind of tell in that area. So I think everything comes down to the kind of regulatory environment. Actually, if businesses feel safe and secure to kind of invest for the long term, they will go to places where there is talent and where there is educated workforce, skilled workforce. And actually places where they feel that they can grow over time. And I think it's, as I mentioned earlier, I think the next decade is probably going to be more competition from different economies to argue their case for inward investment. And ultimately, it comes down to governments have a role in that, and the Romanian government's role to articulate that opportunity and actually articulate the opportunity for inward investment. That's really the challenge that's open, but actually the benefits for winning in that debate and that argument are massive in terms of inward investment, job creation, and wealth creation.
And how do you see the real estate market here? Because we have, I think, the highest yield in this part of Europe, besides Bulgaria, also for offices, but for retail, logistics, residential.
Yeah.
Will they go down a bit?
Well, I think, look, as rates, if rates rise and continue to rise, then and inflation isn't tamed, we have to sort of make an assumption that capital values fall. I mean, it's just capital values have risen globally because interest rates are fallen. There is a direct correlation. So if interest rates are rising, you will find capital values likely to be under pressure. I think ultimately the long-term outlook for property in any economy, including Romania, is actually what's the fundamental happening in the economy. If GDP is rising, if jobs are being created, if demand for space is increasing, there is you will see over time, a growth in rental values and likely, if you've got stable interest rates, a likely growth in capital values. I think the opportunity in every market that we look at, including Romania, is there is a lack of high quality space. And I think that businesses, if you're in the logistics arena, if you're in the office market, even the residential market, there is a lot of opportunity around repurposing, improvement of buildings, whatever market you're in. And actually, irrespective of the fact that office markets have gone through some turmoil in the last couple of years, in every market that we look at, there is a lack of best-in-class stock. Most corporate occupiers at the moment are very keen to occupy really, what's called kind of green, environmentally friendly space with a low carbon footprint. And there isn't enough of that accommodation around. So actually for developers, if they can secure the right sites, if they're able to deliver that type of accommodation in those locations, wherever you are in Europe, there's a real premium for that. The calculations we've done in London, in Sydney, 2 markets we looked at recently, suggests there's a green premium of up to 12% in terms of rental return on those very green buildings. So there's a big opportunity, even when, if you have got access to capital, even in a difficult market as we're moving into over the next 12 months, there is opportunity. And actually what you need to think about is over the next 2 years, because of what's happening to capital markets at the moment, when what's happening to interest rates, there is likely to be a slowdown in investment activity and therefore in terms of development activity in most markets. That will feed through to a lack of supply coming out of the current interest rate cycle. So if you're thinking forward to say 2025 and beyond, in many markets that we're covering, there will be a lack of supply coming out. So actually, do your research, do your due diligence, but in many markets that people are looking at, there is an opportunity here for investors to think beyond the current cycle and to position themselves for the upturn in the global economy.
And being now at the end of the interview, I wanted to ask you about the methodology and how you calculated these numbers.
So in terms of the wealth numbers globally, we have a model which builds on, we have information on, say, the spread of wealth in each economy, the kind of the Gini curves for each economy. We have obviously information on income per head of population. We have information on asset values per economy, and also in terms of forecast, we're looking at GDP growth and also GDP per head, and also the predicted shifts in that spread of wealth across the economy. So the fundamental driver of our forecast really comes down to country level GDP outlook, and that will drive the numbers that we deliver in our report.
I understand. Okay, thank you very much for the interview, and we wait for the next report now.
Thank you very much.